What's up guys, Jake here. In this video, let's talk about a well-known and popular investing strategy that potentially doesn't work. And the investing strategy that I'm referring to is called the dividend capture strategy. If you're not familiar with it, it's exactly what you think it is. Basically, you're trying to capture the dividend payout of as many stocks as possible as quickly as possible. If you're not familiar with it, I'll link the page for Investopedia if you want to get the finer details, but let's just cover the key takeaways. A dividend capture strategy is a timing-oriented investment strategy involving the timed purchases and subsequent sale of dividend-paying stocks. So you're just trying to jump in and out of dividend-paying stocks to collect their dividends. Dividend capture specifically calls for buying a stock prior to the ex-dividend date in order to receive the dividend payout, then selling it immediately after you get the dividend. The purpose of the two trades is to receive the dividend as opposed to basically making it a long-term investment. You don't really care about the performance of the stock long-term, you just want that dividend. Now, because markets tend to be somewhat efficient, this information about the ex-dividend date is known, so stocks usually decline in value immediately following the ex-dividend date. The viability of this strategy has come into question. That's what I want this video to be about. I'm going to run an experiment for you guys to see, does the dividend capture strategy actually pay off? But a quick recap for those who don't know, when you talk about dividends, there are four important dates. There's the declaration date where the company announced the dividend amounts and the ex-dividend date. In order to collect the dividend on a stock, you need to be in that stock the day before and hold it overnight. So if an ex-dividend date is July 1st, you need to be in this stock. You need to have purchased it on June 30th. Now, when the market opens in the morning, you're free to sell the stock. You can sell your stock on the ex-dividend date and you will still get the dividend. The reason why is because the stock takes 2 days to settle. This is the date of record. You're the one who was holding it at the beginning of the ex-dividend date, so on the date of the record, the company will know to pay you. And the payment date is usually like 2 weeks to maybe a month later sometimes. But even if you're not holding the stock on the pay date, it doesn't matter. You're still going to get the dividend. So this is what I'm proposing. I've got about $25,000 in my Robinhood account, and I'm going to dedicate the entire month of July to doing this for you guys. What I'm going to do is I'm going to take all of my money and each day jump into a stock that is having an ex-dividend the next day. Then on the ex-dividend dates, I will then jump to the next stock. And I'm going to try and time this every day of the month for the month of July and see what are the results by the end of the month. This is an idea I've been having for a while. I thought it would be really fun. Now I could potentially lose thousands of dollars doing this, so I'm doing this for you guys. And I don't recommend you copy me or try and follow my trades. This is something that I actually personally don't think is a good or viable investing strategy, but I'm willing to have an open mind and I'm going to give it a shot doing my best for 1 month. So how are we going to pick the stocks that I'm going to be jumping in and out of in order to collect their dividends? In my Schwab brokerage account, I have fractional shares on every company in the S&P 500. So this is 500 stocks. And I have them sorted by the ex-dividend date. So we are going to start this challenge on July 1st. So we need to scroll down. This is all the stocks that pay a dividend, guys, in the S&P 500. And I want to do it only on S&P 500 stocks because these are large cap stocks that are not easily manipulated. They don't have a lot of volatility like small cap stocks do or penny stocks. So when we look at all the stocks that have an ex-dividend date on July 1st, it is American Express, Bristol-Myers Squibb, General Dynamics, Globe Life, Lennar, Simon Property Group REIT, and Cisco. So I can only be in one of these stocks the day before and then collect the dividends on July 1st. So I have to choose one. And I could just go random or I could go for the one that has the highest dividend yield, but I actually think I should be smart about this and choose a stock that is currently in an uptrend. You don't want to be in a stock that's downtrending because then on an ex-dividend date, it should drop even more. So let's try and time this by swinging in and out of only healthy stocks they're currently in an uptrend. So let's first check out Bristol Myers Squibb because it's got a dividend yield of 3%. How much would I be getting of that? If this is a quarterly dividend, take 3 divided by 4, and that's what the dividend payout will be. So let's go ahead and investigate Bristol Myers Squibb and just, take a couple seconds to look at their stock chart. And when I look at this chart, you'll notice there's some pretty wild swings, going from 63 down to 62. That's over a 5% drop in a week. So this stock is uptrending, but it's looking pretty volatile. So even though it's got a nice 3% dividend, I'm going to pass on it. Next company I see 4.2%. That's pretty decent. So the dividend that I'll get is a little over 1%. So if I put in $25,000, that's $250. So let's look at SPG, and this is a REIT. SPG. Check out their stock charts, and this is looking really nice. Notice the 4 moving averages, the 20-day, 50-day, 100-day, and 200-day are all lined up. This is a strong uptrend. So yes, this stock potentially could pull back on the dividend payout dates, but it's generally uptrending anyways. So I think this is a good company to schedule in for myself to jump in and out of on July 1st. So I've already gone through all of the dividend-paying stocks in the S&P 500, and this is my game plan for the entire month of July. I think there's some holidays in July, like the 4th, so and obviously I can only trade on weekdays because the market isn't open on weekends. So there's 21 potential days to jump in and out of a dividend-paying stock. And unfortunately, there are no companies in the S&P paying a dividend on July 12th, July 16th, July 23rd, and July 26th, and July 28th. So what I can do is I can investigate some small cap stocks to see if any smaller companies have ex-dividend paying dates, but I haven't done that yet. I'll do that later. And this game plan is tentative. A lot can change in a stock price over a month. So I'm going to check these stocks the day before to make sure that they still look safe to get in and out of. Obviously, a newsworthy event can plummet a stock price at any time. So I'm going to be careful. I'm going to be smart. I'm going to try and stick to only safe companies that are generally uptrending. But these are their annual dividend yields. So total is 41.7%. So if these are all quarterly dividend paying stocks, and I believe they are, some companies will have special end of the year dividends. So that counts in their dividend yield, but it doesn't help me for July. And I should be able to make about 10% from just capturing dividends over the month. So if I'm doing this for $25,000 swinging in out, I should be able to capture about $2,500 by the end of the month. However, I need to account for how many shares I'm buying. I can multiply the dividend payout per share multiplied by the number of shares that I buy. That'll be my dividend profit. But I then have to calculate how much I paid to purchase those shares and then how much I sold them for the next day. So if I sell them for a bigger loss than I'll make off the dividends, then my profit and loss will be negative on the day's interaction. However, if I sell it somehow at a break even, or if I sell it for a profit in addition to the dividend, then that'll be nice. So I'm going to keep track of all this, track it for a month, have some fun with it. If you guys want my suspicion, I think that I'll probably end up exactly where I started or no different at all. I don't think I'll lose that much, but I also don't think I'll make that much either. So let's go into the specifics of the problems with the dividend capture strategy, just so that you're aware. And the first one is the market should be perfectly efficient. The ex-dividend date is announced. It's known by everyone. The market should be pricing it in. Now, this doesn't always happen. However, think about it. Let's say that you jump into a dividend-paying stock. Then on the ex-dividend date, the stock price went up. Why would it do that? The reason why is because there could be market forces or news. Now, the dividend payout was taken into consideration. So if the stock price went up on the ex-dividend date, then it actually, if there wasn't dividends being paid at all, it would have gone up even higher. the dividend was priced in. The stock still went up because it was uptrending, but it would have gone up even higher had the company not been paying a dividend. That's something that you can never prove, but that is the argument for why dividend-paying stocks can still go up on their ex-dividend date. Additionally, I might sell at a bigger loss than the dividend earned me if it's a stock that takes a downtrend or has some bad news and there's a huge sell-off. I easily could be trapped with a lot of money in a stock that just happens to have news breaking on the ex-dividend date. Number 3 is this strategy is not tax efficient. Generally, you have to hold a stock longer than 30 days to get qualified dividends tax rate. This is long-term favorable capital gains. But if you're jumping in and out, then you're paying short-term capital gains, which for me will be about 22 or 24%. So I've got to factor that in as, you know, I got to pay all these taxes. It's more than 50% than the short-term rate of 15%. There is a way around this problem, though. If you do a dividend capture strategy in your Roth IRA, you don't have to pay any taxes on the dividends, so it's something that some people do. Number 4 is, will I actually even be beating an index fund? I am going to buy one share of State Street's SPY ETF. This is the S&P 500. I'm going to buy it June 30th and hold it for the whole month. I have to beat an index fund doing it because it could just be a good month for the market and everything in general is going up. So if I don't outperform an index fund, then I'm not really proving anything with this investing strategy. And then finally, since on my channel I teach you guys about trading options, is there actually a better way to take advantage of these known dates where the stock price should be going down? And I've looked at a couple charts and I just don't see it. I don't see any pattern or consistency when ex-dividend dates occur of the stock price going down by that amount, which is what draws in people to the dividend capture strategy, because you see it as often as you don't see it. However, let's just assume that the market is perfectly efficient, the price drop is priced in, and it does occur. Why the heck are we buying stock when we know the stock will go down? If you're not aware, these are the 6 tools available to you as a trader. You can either buy a stock or short sell a stock, or you can buy a call, sell a put, sell a call, buy a put. These are the bullish strategies, and these are the bearish strategies. So if we know on an ex-dividend date that the stock price of a company should be going down, why don't people just short sell it? And the market has thought of this. If you were to short sell a stock the day before the ex-dividend date and then buy to close it for a profit because the share price of the company went down on the ex-dividend date, don't you just automatically make money? And no, you don't, because your broker requires you to pay back any dividends that are missed when you short sell a stock. So not only are you buying to close it, but you have to pay your broker back once the dividend is paid out for the stock that you short sold. So you can't short sell a stock to take advantage of ex-dividend dates. The next thing you could do is potentially sell a covered call on a stock. Now, if you want to be wild and get approved for and sell naked calls, I don't recommend this, and I personally would never do this. But there are advanced traders that do the dividend capture strategy who will buy hundreds of shares of a dividend-paying stock, collect the dividends, and they're selling covered calls on it, hoping that the share price of the company does drop by the predicted amount. When you buy options, in the short term, this doesn't move the stock price. If you buy and sell stock, that moves the stock price. But if you buy and sell options, that day it's having no effect on the share price. So there are traders who will sell covered calls in addition to jumping in and out to take advantage of the dividend payout and the stock drop. Interesting, but I personally just don't want to be consistently buying hundreds and hundreds of shares to try and squeeze a little bit of theta value out of doing this. The third option actually gets me the most interested. Is it possible to buy a weekly put contract to take advantage of a price drop on an ex-dividend date? So buying a put doesn't affect the share price movement because you're not buying or selling stock. And the response to this is options traders should know about the ex-dividend date. They should be pricing it in. So people buying calls and people selling puts should know about the ex-dividend date and pricing it in, but honestly, are they really doing it? I don't know. So I want to get through this month just jumping in and out of dividend-paying stocks and see what happens after a month. I'm using a lot of money to do this, so we're going to get some dramatic results. But I am interested in maybe in the future potentially developing an options trading strategy around dividend-paying stocks. If I can find dividend-paying stocks of bad companies that are downtrending, do they downtrend or fall more dramatically when a dividend is paid out? That's something that I've not really looked into, but something that really interests me. And yeah, there might be something there. But let's get through July 1st. I'll give you my results in an updated video at the end of the month, and then we'll keep thinking of different investing and options trading strategies on this channel. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, follow me on Instagram and Twitter. I will post updates of my dividend capture strategy challenge. We'll have some fun with this, and I could potentially lose a lot of money. We'll see. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.